Let me welcome all of you on this rainy morning to the Peterson Institute for International Economics. Our new president, Adam Posen, is up testifying to the Joint Economic Committee this morning on the remit of the Federal Reserve, so an important topic, and he asked me to, for a moment, take my old place as chairman of these sessions here at the Institute. I could not be more pleased to do so, to introduce our speaker today, Anders Borg, who is both an old friend and close associate, and literally, probably the world's top finance minister. He has been named such in Europe. He's the dean now of serving finance ministers in the entire OECD area, and that's not because he's an old guy, as you can see from his countenance. He's been Minister of Finance in Sweden since 2006. That does mark a rather long tenure for such positions. He's been the chief architect of the Swedish government's economic policy, which of course has propelled his country into the most successful response to the crisis and successful navigating of the crisis of any, certainly in Europe, and one of the most in the world. So it's a great pleasure to welcome Anders back to our podium here for the third time. Prior to becoming finance minister, he was chief economist of the Moderate Party. He was an advisor on monetary policy to the Riksbank. He headed up the economic analysis department at SEB, Skandinaviska Skodebanken, and was a political advisor to Prime Minister Carl Bildt back in the early 1990s when Sweden overcame its own economic crises, dramatically reformed its economic policies, and put itself on the course to where it is now so successfully navigated, responded to, and overcome the crises of the last few years. So, Anders, we're delighted you're here in town for the IMF meetings. It's a very great pleasure and privilege to welcome you back to the podium here at the Peterson Institute, and we look forward to partaking of your wisdom once again. Great to see you.
Thank you very much. I will give some views on the current position of Europe and basically how I view that we should use fiscal policy in this kind of situation and going forward. There will be three basic messages. One is that the crisis is not over. I think we still have some clearly political risks in Italy and Spain that can come back and create some further turmoil in 2013, and maybe it will take some time even longer than that to sort things out. The second message is that I think we should be using fiscal policy as a tool of stabilization. There are obviously some limits to what can be done with fiscal policy, but basically I think we should try to organize our economic policy setting so that fiscal policy can play an active role to stabilize demand and growth. I would also argue that the debt level is in Europe quite a problematic issue, and some of these fundamental issues that are different between the US and Europe is that in the depth of the structural problems are much worse than they are in the US, particularly on the labor market, but also when it comes to long-term growth numbers. So in Europe, part of the solution must be that we are changing the functioning of our economies and doing long-term structural reforms. If we look at the short-term economic prospect, I think it's quite clear that we are not out of the woods yet. I think we have some quite fundamental problems in some of our European economies that has not been resolved. If we look, for example, at Italy, they have a unit labor cost situation which brings them some 30-40% above Germany in terms of cost level. The difference between Italy, Greece and Spain is that in Italy they are still moving in the wrong direction. In Greece and Spain we've seen quite a dramatic increase of productivity and a very low cost pressure, which means that they have regained quite a lot of their competitive situation. That is not the case so far in Italy. There has been very ambitious reforms from the Monti government that is moving in the right direction, but we can actually see very little effect of that in data so far. The problem with that is it's quite clear that Italy needs to continue to reform maybe for another 5 to 10 years. And given the current political situation after the election, it is very hard to see how that could be really solved. So therefore, I think one has to be very optimistic if one don't think that the problems in Italy will come back to the on top of the agenda. Also, when we are looking at Spain, I think we have a quite problematic situation, particularly in the banking sector. There is a drop now in bank lending to households and firms of almost 15% if the numbers of the World Economic Outlook is correct. It actually looks like a severe contraction only in the last 3 to 6 months. It's gone from minus 10% to minus 15% since October. Those kind of numbers are indicating that there is still a quite heavy monetary contraction. I think we still are in a situation where house prices have not stabilized. So to my mind, it's quite clear that not only Greece, but also Italy and Spain might come back to the agenda. And I think we should be clear that the next round of Troika negotiations will come back to the agenda in May. And I think the best guess is that we are still seeing some slippage when it comes to expenditure control and revenues in Greece. So from a US perspective, it's quite clear that the economy is starting to come out of the crisis and start to regain some more normal pace and of a recovery. From a European perspective, I think one should be cautious. Both the fund and ourselves and the Commission are actually forecasting negative growth this year. We had negative growth last year, and the growth forecast for next year of the Eurozone is close to 1 percentage point. So the weakness of the recovery in Europe, I think, will remain. And I'm not certain that the market is actually appreciating this fully. We are now seeing the bond rates going continuously down on the back of the Bank of Japan's very, I think, reasonable action. But the problem is that there could be quite some setbacks when it comes to political risk, to my mind. It's important that to realize that this is a structural crisis. If we look at GDP growth, it has not been strong in the US. It's been better in Sweden, but I think nobody should be satisfied with the growth rate of some percentage point. The problem is that the euro area has actually been worse. And if you take a longer term perspective, a 10-year perspective or a 20-year perspective, the growth numbers have been quite poor. There's been several countries where the total factor productivity growth has been below 1%, which I think is a very dismal result. Also, when we are looking at unemployment, the unemployment and employment rates, labor force participation, long-term unemployment, it is quite clear that Europe is in a much worse situation than the US in terms of the labor market. Obviously, that is also what we are seeing in the employment rate here. Even the US, with its close to 68%, 67, 68%, is on the lower side, I would argue. But the potential for the euro area to increase employment rate is quite substantial. I think it would be very reasonable to see the levels up well above 70%. And they are now currently running at 64%. This is indicating, together with the unemployment rate, that there is a fundamental structural problem in the European labor market. In combination with that, we have now quite high debt levels in all of our big economies, and that's a part of the picture. Let me say a few words of how one could assess the situation and the fiscal stance for years to come. I actually would argue the case that Europe is at a quite reasonable balance as it is. If we look at the countries with a relatively strong position, the UK and France, what they have done is actually to postpone not the measures, but they have let the automatic stabilizers work. So, for example, I think the UK is going now down to 5% deficit from a top level of some 10% at the deepest part of the crisis. So it's not there has not been the media picture is that there's been a very dramatic fiscal austerity program in France or the UK. I would argue that they've done quite a balanced pattern back. If you look at the UK data, it's very similar to what we are seeing in the US. I think the numbers are almost Siamese twins between the UK and the US. In this situation with weaker growth, I think it's very reasonable that they take some more time to achieve the 3% target of the deficit. That they can actually see tax revenues go down a little bit and expenditures increase a little bit and take some more time. But I don't think they actually have room for doing active fiscal measures. Then we have the countries with a relatively strong position. That would mean Germany, Finland, Austria, Sweden, Denmark, maybe also Norway and Switzerland. If you take the German position, I will compare Germany and Sweden. I think actually the German government has struck the right balance when it comes to dealing with their budget issues. They are now at 80% debt level. Maybe one could argue that they could take on 10-15% debt more without creating any real long-term problems with the anchor of the Eurozone. If we are thinking of increasing the German debt, one should ask oneself, what should that be used for? Is it better to use that as a buffer for other Euro countries that might run into problems? If there is a non-negligible risk that another country would go into a program, it is quite clear that you need to have a solid backstop for that. If it in this crisis or in the next crisis would happen, I would argue that it's more rational that the fiscal space in Germany is used for creating a backstop for the rest of the euro area. Particularly, one should remember that we are now in Europe building a banking union. A banking union means that the ECB will take over supervision, but it also means that we will need to build some kind of common deposit insurance system and also some kind of resolution authority. Well, that also means that there has to be a solid backstop for the banking union. So if there are some fiscal space in Germany, I think that should be used for creating stability and anchoring a banking union with the German backstop. And if we are looking at the German situation, let's remember that before the crisis, Germany had 10% unemployment. It today has 5% unemployment. Unemployment in Germany has been halved during the crisis. Labor force participation has actually increased 3-4%, and employment has also increased, and youth unemployment are today well below 10%, almost 5-6% lower than the equivalent numbers for the US. So it's quite clear that the number of available resources in Germany are not as they are in for example, the US or the rest of Europe. So I would argue that maybe in Germany you could do measures where you are maybe cutting taxes in the short term, but then you need to anchor that in a path for expenditures that is on the downward side. Otherwise, I don't think there is much fiscal space in Germany, and the space that is should be used for the Eurozone and for the banking union, not for short-term stimulus measures. In my own country, I would argue that we actually have fiscal room to maneuver, and I would argue that case to give a kind of a contrast to Germany. Our debt level is 40%. We have had structural surpluses all along during the crisis. We have actually an 8% unemployment, which will not go down to 6% until maybe 16 or 17. So it's quite clear that our output gap is much bigger than the German output gap. We have a current account surplus of some 7-8% currently, and we basically have a credibility problem in the reverse. We are seeing the krona strengthening every time there is turmoil in the world market, which is not what you actually would like to see. So for us, it's quite clear that you could see arguments for doing further fiscal stimulus in 14 and maybe also 15. But by saying that, I also think that it would be very, very difficult to argue that case for Germany. In the Swedish case, I do believe that what we will be doing is long-term growth measures. We don't believe in temporary or targeted fiscal stimulus, but rather continuing dealing with our own structural problems and cutting back taxes and increasing spending on education in the long term, rather than just doing short-term progress. So there is a picture in the media that Europe is only about austerity. I would argue that austerity is necessary for some of the countries that is in complete lack of market credibility. But even for Spain and Greece, the decisions taken in the ECOFIN has said that they are actually accepted that the implementation of these measures are prolonged. Spain, for example, is going for 10% deficit last year to 7% deficit next year. Obviously, that is a deficit reduction, but it's not a dramatic deficit reduction. And I would argue that the balance is there. So the main issue for the euro area is not about fiscal policy in the short run, but rather to create a banking structure, a banking union that would alleviate the pressure on the credit market. So what can we say that we have learned in the crisis about fiscal policy? Well, I think the major lesson is that fiscal policy is a tool that should be used. When I was working at the Riksbank, I think the common wisdom among central bankers was that stabilization policy was for monetary policy. You would use an inflation target and you would use your policy rate to balance output and unemployment. Today, I would argue that almost everybody believes that fiscal policy has a role to play, and there are some very important arguments for that, particularly if you have a debt deflation situation or a zero boundness problem where the efficiency of monetary policy is extremely weak. If you have a large construction sector or a housing sector that's gone from a boom to a bust, it is fairly likely that a country would very much look like the US, Ireland, Spain for a quite prolonged time period. And in such a situation, it's very reasonable to do what you can from fiscal policy to stabilize the situation. So if we realize that we need to use fiscal policy, I also think we've realized that debt is much more important than we thought. Oliver Blanchard, who should not be considered as a fiscal conservative, argued at the conference at the IMF now that previously we thought that a 60% debt level was safe for countries. I think Ireland, Latvia, Iceland, Spain and a lot of the other countries have shown to us that 60% is not safe. At 60%, you're only a banking crisis and a long downturn away from coming very close to unsustainable debt levels. And the problem is that we have actually seen financial crises almost every third or every fourth year over the last almost 20 years. If you go back and start with the Mexico crisis, that was only 2 or 3 years before we had the Scandinavian crisis and banking crisis. After that, we have also the UK going into an ERM crisis, and then obviously we saw another round in Mexico in 95, and then the Asian crisis came in 97. We had LTC and Russia in 98, and then we had the dot-com bubble in 2000, 2001, and then we had the Great Recession that we're now living through. So I think one should realize that we are living in a very turbulent and problematic world. So we have to take the debt level serious. If you believe that fiscal policy has a role to play, it is extremely necessary to pay down debt and get back to a stable situation. So how can this difficult conflict between debt and the need for use of fiscal policy be squared? I would argue that it has a lot to do with institutions. We need to change the institutions around fiscal policy to create a budget process, a policy setting process that is much more long-term stable, but also adjusted to being able to deal with the necessary issues. Just to give you the kind of sense, because most people don't realize how long the lags are in fiscal policy. When we are deciding how to use our own fiscal space, let me take the example this year when we have cut corporate taxes down from 26 to 22%. That had to do because we had a lot of problems with interest rate deductions being used for tax evasion. People moving profits out of Sweden into Cyprus or Ireland or other countries. So big loans in Sweden with deductions and the profits taken out in low tax zones. So when we have to deal with that, the legal complexity of the issue, we have to start we do the budget in September. 2 weeks after we've done the budget, I gather my chief policy advisors, and then we start on the next budget. Because that's the time lag. If you want to be able in April to have a proposal that can go to our legal counsel, which is a requirement before it goes to Parliament, you have to do all the preparatory work so you could send it out for being assessed in early February, March. So basically, if you're going to do a structural reform, at least you need a year ahead to plan for this process. And a lot of things can change over a year. I mean, you definitely can see fiscal deficit going up 1%, 2%, or even 3% in a year because the forecasts are so uncertain. So you need to have a long process where you can be flexible. And particularly if you believe that the key, at least for Europe, is to do structural long-term measures to improve growth and the labor market. And that, I think, puts a lot of demand on how we are organizing fiscal policy. You also, I think, need to see a fundamental change of the fiscal institutions so that you're creating room to maneuver. In Sweden, we have a situation that if we don't do anything, there will be a fiscal contraction of 0.5, 0.6, 0.7% per year. And that has to do with the fact that we've set a large part of our subsidies for the welfare services in nominal terms. So if there are no political decisions, automatically in real terms there is a decrease of spending. We have also introduced a system where basically all the government agencies have to, when they get compensated from wages and prices, there is a deduction from the average private domestic sector productivity. So also in the public sector there is a demand for productivity increases. And this means that if we want to do measures to stimulate the economy, we can do that. And it's still credible that in 4 or 5 years we will be back on track automatically. Normally there will be political decisions to increase spending on education and so forth, but it's institutions in the system that we are not stuck in an incremental trend towards increasing public expenditures. And that gives you a complete different situation when it comes to reprioritizing public expenditures. It's easier to spend less on transfers and more on education, less on inefficient public services and more on research and development or infrastructure when you have an automatic pattern. And in most other countries, you have a strong drift upwards on the public expenditures, which automatically takes out your room to maneuver. And that, I think, has to be fundamentally changed. I also believe that a big difference between the US and the Europe policy debate, where the US tends to think that it's only austerity in Europe, I think that has some fundamental reasons. And one of them is that in Europe, people are much more depending on the welfare state. If you look at the welfare spending, Sweden is almost 7-8% higher than the US. I actually think that this is we have created a very good welfare model in Sweden, so I'm not showing this to indicate that we should cut our welfare spending and go to the US level. But the point is, if you're a Swedish parent and your kid is starting in school, you actually want the school to be good. You will not say, well, it's a downturn, so I will now, the first 3 or 4 years, there will be very poor education, but eventually there will be some education. If I have a heart attack, I don't want to hear that the output gap is very big and we cannot use public spending. I want to know that I have a good surgeon waiting for me. So when we're talking about credibility, in the US debate, it has a lot to do with market credibility. For us, it has a lot more to do with the social contract. The Swedes are paying their taxes. The Germans are paying their taxes. The French are paying their taxes also, to a lesser degree, but basically, because they believe that the social contract works. The problem with high deficit and high debt is that the fundamental basis for this contract becomes shaky. If we're going to do expenditure cutbacks, we know that that will hit the welfare services, education, and healthcare. So to keep the trust level in society up, if you want to have a welfare state, you need to be fiscal conservative. Because if you're depending on the markets and if your populations that start to feel that this is not stable and long-term sustainable, you will start to get the trust level being reduced and the society, the foundation of society not working as well as it could. So there is some very strong arguments for a social market economy where you will have high social spending, but then you also need to be much more cautious when it comes to fiscal policy. And you have to work with the social engineering issues of how you create and deal with the structural problems of labor market that you normally get from high welfare spending. Some of those problems can obviously be alleviated by active labor market measures, by eligibility criteria, with control mechanisms, and so forth. But if we believe that the welfare state is a model that we want, we also have to do the social engineering work to keep it well functioning. And I will get back to that because I think that is a key problem for Europe. So this is challenging times for Europe. It's a banking crisis, it's a debt crisis, but it's fundamentally also a structural crisis. And sometimes I'm not certain that US economists really understand the difference between Europe and the US. If we look at the structural unemployment rate, I think basically these are the numbers from the OECD. I would argue that most US economists would say 5, 6. Very few people probably would say above 6. Some would probably argue that you probably don't. You could potentially even come down a little bit. For the euro area, the structural unemployment is close to 9%. Very few people would say, I've never met the European labor market economists that would argue that the Eurozone could have 5% unemployment without creating fundamental resource problems and inflation pressure. And this has to do with very fundamental differences of our societies. The strictness of employment protection. Sweden is slightly below the euro area. I don't believe in big overhaul of employment protection. I don't think that there is a very strong case for us doing reforms of our labor market, but rather trying to find incremental changes together with our social partners. But it's quite clear that employment protection in the US is fundamentally lower. And that has some implication for wage setting, labor market flexibility. And also if we look at marginal tax rates, it's come up a little bit in the US, but using different measures, one should clearly see that there is a difference of some 5-10% in marginal tax rates on average between a normal European country and the US. Sweden is slightly below the euro area, but clearly also above the US. Product market regulation, there you can clearly see that there is a big difference, and that is important for labor market. In any normal Nairo equation, you would have a learner indicator, a product market indicator, where more product market barriers and product market regulatories create labor market inflexibility. So, from a US context, there is the argument that there could be a lot of more fiscal stimulus in Europe. Well, I would disagree, partly because what I've said about Germany, but also because the real issue in Europe is structural. It's about the labor market. It's about getting the labor market functioning better, not go to a US Anglo-Saxon labor market. I actually strongly believe in the social market economy, but we have to reform the labor market so we get higher work participation, particularly for women. Many of our European countries are seeing women work participation down at slightly above 50%. I would guess that you have a GDP potential for gender equality in Europe around 20% of GDP increase, if we would see maybe a kind of a Swedish labor market for the whole of Europe. I would guess that you would actually increase GDP something like 20 to 25%. So in the US, demand policy is more likely to be efficient because there's a flexible supply side that works and takes the demand without bringing up inflationary pressure. In Europe, that's not the case. And you should fix the fundamental problem when you deal with economic policy. The fundamental problem in Europe is an overregulated, inflexible labor market with a welfare state where work incentives are not strong enough. And that would be the kind of core argument. So what Europe should do is to really confront its fundamental structural problems. First part of that has to do with fiscal policy. I think we've done enough when it comes to building a stricter budget process. What we now need to do is to create also a flexible process where we can actually use fiscal policy as a tool. And that is something that one has to work through very, very carefully. But then I think the structural issues should be on top of the agenda. If you look at a country like Italy, the cost level with some maybe 25, 30, 35%, depending on the measurement that we are using, in increase over Germany. France is doing pretty well when it comes to the manufacturing sector, but in the terms of domestic sector, they look very much like Italy in terms of costs. How can this be fixed? Obviously, you need to deregulate your service sector. You need to open up your domestic sector for competition. Barriers of entry has to be cut down, hinders for competitiveness, price regulation, entry regulations, all of these has to be reformed so you get a much stronger base for total factor productivity. Let's remember that some of these European countries have seen total factor productivity in the neighborhood of 0 to 0.5% over the last 10 to 15 years. And that has to do with an overregulated domestic sector. Obviously, some of these structural reforms can also strengthen public finances. Pension reforms being obviously that, but also early retirement, sickness benefits and unemployment benefits needs to be reformed in some of the European countries. It's not that we don't need welfare transfer or welfare services. The case is that you have to reform them so that you can provide good economic security while strengthening the work incentives. It has a lot to do with social engineering rather than just cutting back benefit levels. And Europe also must tackle its labor market problem. I've spoken quite a lot of that, but that I think is the key. And increase hours of work for hours, involving the social partners. We have now seen deals between unions and employers in both France and the Netherlands. In Sweden, we're working very heavily on the same kind of process, increasing flexibility while also putting more resources into getting people back to the labor market. And then eventually we have to strengthen the institutional framework. I will argue that we have to do this, but one should realize that there is a quite problematic democratic issue that has to be dealt with. If you have a monetary union, it's very logical that you ask for a banking structure, a banking union, where the features has to be supervision, deposit insurance, resolution, and that has to come into place. Having said this, I would still argue that we need to also take into account the functioning of the whole union and also of the democratic legitimacy. It's not possible, to my mind, to see big transfer payments moving in Europe without creating political problems that would, to my mind, undermine the political stability of the European system. I don't believe in creating a situation where we have populist parties arguing against Europe in almost all of our major European states. So there is a need to work on the democratic legitimacy and to take this step with a strong ownership from the different countries when it comes to moving forward. So a summary would be, for Europe, there is a fundamental need to improve competitiveness and to improve the functioning of the economy, both in terms of opening domestic service market to competition, but also in terms of improving the functioning of the labor market. And I do believe that we should reform our fiscal policy institutions so that fiscal policy both can be an active policy instrument while we are also seeing long-term debt level coming down to what has to be sustainable to have a stable and a credible environment for fiscal policy. So that was the main messages today, and I would be very happy to take questions and remarks and comments. So thank you very much.